The US Federal Reserve has hiked interest rates by 0.75% for the second straight month. With this, the overnight borrowing interest rate now hovers in the range of 2.25% to 2.5%. But how does it impact stocks, especially the dividend players? Dividend-paying stocks have always remained in demand amongst investors. The importance of these stocks increases significantly during challenging times, as these ensure a steady stream of income. Dividend stocks assume greater importance when the rates are low. But what happens to these stocks and their payout ratios when the central banks start to raise rates? The stocks with the highest dividend yields, belonging to sectors such as telecom, real estate investment trusts, and utilities, are typically the most sensitive to interest rate rises. This implies that their prices fall with every single rise in rates and vice versa. The debt servicing costs of the firms with higher debt loads increases when interest rates rise, resulting in a negative impact on their profitability. Interest rate changes can impact the profitability of companies, thereby constraining their dividend payout capacity. It's more evident in the case of debt-laden firms. It's also been witnessed several times that the mere anticipation of rate hikes in the US can have an impact on the profitability of companies all across the globe. Higher interest rates in the US can make the US dollar stronger, which ultimately lowers contribution from foreign earnings, thus impacting the profits of a company. Likewise, muted commodity prices have a negative correlation with the greenback. It can have a significant impact on the profits of commodity producers. But what about the impact on bond yields? An interest rate hike is usually followed by an increase in stock market volatility. In such a scenario, investors find short-term debt and certificates of deposit attractive when interest rates rise. Even the longer-term bonds look attractive as their yields rise while bond prices fall in line with climbing rates. But investors should also be aware of the fact that while equities offer the prospect of capital appreciation along with dividends, debt offers low competition at a time when yields hit record lows. However, not all stocks are impacted by interest rate hikes. Take, for instance, banking stocks, which tend to do quite well even when the rates rise. It happens because their net interest margins improve, resulting in a positive impact on their profitability. So, there you have it, some of the key impacts that yet another US Fed rate rise could have. Do you support the approach of the Fed? Let us know in the comments below, and don't forget to like and share the video. For more content, you can subscribe to the channel and also press the bell icon. I'm James, reporting for Kalkine.